you get into the implementation phase, which to me is the most important. So once we bought the Palms Apartments, we bought it from an operator that we thought wasn't operating the property correct, and we thought we could bring the values up. Typically, right now, you guys are going to be buying property for your investors, or your investors are going to be buying property, and they're going to be buying at very low per door acquisitions. It's a great time to get involved with real estate investing. We know that. So they're buying, bring income. In the growth phase, the property managers focus on maximizing the income and minimizing the expenses. Maximizing income is accomplished by growing the net operating income of the property, while minimizing expenses is accomplished through careful budgeting and routine maintenance, as well as preventative maintenance. Once the income has grown, you have essentially increased the value. This sets up the final phase, which we call phase 5. The final phase is the exit strategy, where the investor, he or she, in the final phase, the investor feels he or she has. Once the phase has been realized, the investor looks at either to sell or reposition the returns into a greater investment or cash out. Think of it like a real-life game of Monopoly. The goal is to buy a greenhouse, or 1 greenhouse equals 5, or 1 red hotel. So our 5 greenhouses equal 1 red hotel. Because they'll make a verbal agreement with the tenant. So at the end of the day, that's why I'm very careful and very skeptical of just watching. I have to see who is actually doing the rent reasonableness for HUD to make a determination. But I do factor that in as well. Yes, ma'am. I just see a lot of stuff. I see a lot of stuff. All right. Now, most of you guys are sitting here going, okay, I own an apartment complex, or I own a single-family house, and some of you are probably sitting here going, okay, I just manage. What on earth does all this fancy cap rate and cash on cash and buying have to do with me? As a property manager, as I said, if we don't know all 5 phases of property management, we're not skillful property managers. We have to know acquisition as well as we know stabilization. Okay? I want you to know acquisition as well as you know how to put a 3-day notice and kick someone out. Okay? You have to know every phase of property management. I don't want you to just be good in one area, or great in one area. I want you to be good in all areas. Okay? So we're going to end the financial with understanding the DNA strain of an investment property. Doesn't matter if it's single family, doesn't matter if it's medical, office, strip mall, doesn't matter what it is. Every property that charges a rent or has an income has a DNA strain, okay, which is identified. The first in the DNA strain of an investment property is gross potential income. Gross potential income is defined as the annual income that you will receive when considering that all the units were occupied and all tenants are paying market rent. Minus vacancy. Vacancy and collection losses contributed to vacancies, turnovers, and non-paying rentals. Now, I put in 5% here, but obviously it can be anything. Whatever the market, whatever the vacancies are, the historicals are showing us in this particular area is what we'll plug in. Be careful when you're buying property and what the owner or the seller is plugging in. You need to verify that those occupancy levels or vacancy rates are actually the vacancy rates in that particular area, because that can change the value, as you'll see real quick, of an asset. Gross potential income minus vacancy will equal EGI, effective gross income. Effective gross income is defined as your total amount of possible rents minus vacancy and collection loss. EGI plus OI, effective gross income plus other income. Other income is defined as money received from sources other than rent. Examples are washing machines, vending machines, etc. Effective gross income plus other income will equal your GOI, gross operating income. Gross operating income is defined as the sum of EGI and OI. The gross operating income is the total amount of cash the property has at its disposal for paying expenses. Gross operating income minus OE. OE operating expenses are defined as all expenses, fixed and variable, that are accrued while operating the property. Fixed are property taxes and insurance. Variables are things like maintenance expenses that may go up and down according to the market. Gross operating income minus OE, operating expenses, equals NOI. Net operating income. Net operating income is defined as income remaining after all deductions. NOI is used to calculate the return on investment. Okay, NOI to me is one of the most important. I would circle that or highlight that. NOI minus RRA, reserve for replacement account, is defined as the replacement reserves that is designed to save for replacement costs of items that wear out and must be replaced, i.e. roofing, boilers, parking, ACs, areas, things like that. Items like roof repairs. In Florida, it would be AC units, up north, boilers and things like that. Then minus your debt service, DS. Debt service is defined or better known as your mortgage payment. In its entirety, the DNA strand will look like this above. Gross potential income minus VAC equals the effective gross income on the property. Effective gross income with any other income that the property produces will equal the gross operating income of the property. Gross operating income minus the operating expenses will equal the net operating expenses of the property. And then you minus out any reserve for replacements or debt services will give you your before tax cash flow. Does this formula get any more complicated? You bet. But any more simpler? Not really. In its most simplistic form, if I were to take a unit and someone says I want to sell you 300 unit apartment complex, on a napkin, I could evaluate the asset based on my position, my financial position. Because cap rates and cash returns, and this is, and I don't want to get too far ahead, but I'm going to tell you the difference between the two. Cash left over, the before tax cash flow. The before tax cash flow is defined as cash generated before the taxes. Cap rate. A cap rate is net operating income divided by the value of the asset. Cap rates are primarily used to help estimate the value of income properties. A cap is a measure of absolute return. An example, if a property has an NOI of $100,000 a year and the property is worth $1 million, the $100,000 returns 10%. Thus the cap rate is what? 10%. Absolutely. Rule of thumb, lower the cap rate, usually higher the asking price. Okay? Lower the cap rate, usually higher the asking price. So if you see it like in Boca or in the area Billy showed me, you're going to see low cap rates because those are high asking prices.
High income, low return.
Absolutely. Equity divided rate formula, which is a fancy word for cash on cash return, is before tax cash flow divided by the owner's equity. That's how much money he or she put up. Cash on cash returns differs from the cap rate. How? When you use leverage, i.e. a mortgage. Example, if an investment property returning $15,000 after the investor makes the mortgage payment and having equity, i.e. down payment of $103,000, it returns 14.5%. So the investor that sought out a debt or a mortgage increased his or her return because they didn't have to spend $1 million. Like investor number one, they only spent $103,000 of their $1 million investment securing debt and then obviously raising their cash on cash return. Okay? It's about the tolerance level of the investor. Some want to buy cash and not deal with debt. Okay? If I had bought the Palms Apartments cash, I wouldn't be dealing with the foreclosure issue. So, we would have just rolled out the storm. But we would have emptied all our tanks. All $1 million would have went into one property. So if something happens to that one property, then all the $1 million is gone. So at the end of the day, it's the great debate. The use of leverage or the non-use of leverage. Some like it, some don't. It depends on the taste the investor has or the appetite the investor has or the risk tolerance he or she has. Okay? We're just simply showing you from a number standpoint how he or she, if you borrow money, if you rob Peter to pay Paul, your rate better be higher than it is than investor number one, or you've just borrowed money with a negative repayment rate. Okay? So if I paid $1 million and I'm getting a 10% return, if I go and borrow money, that money is going to come with a cost. So if I borrow money, I better increase my return, or I've just borrowed money at a negative repayment rate. Which makes no sense at all. It's like being upside down with a vehicle. Pretty much the same thing. Okay? The leverage permitted by lenders is influenced by two cornerstones: the relationship between the loan amount and the market value, and the relationship between the annual debt payments and the property income, which is the NOI. Banks look at what we call debt coverage ratios. This is the relationship between annual debt payment, principal and interest, the NOI. This is a widely used benchmark to evaluate a property's ability to cover the mortgage payment. At the end of the day, that's what they're concerned about. Is there enough money that this property produces to pay back their mortgage? Okay? Now, when I broke off into doing that the NOI, the net operating income, is under distress or it's eroding. And because of the erosion of the NOI, the value